Barry, always good to see you. So, listen, Barry, I got another day in the green. Green everywhere. Listen, small caps, they joined the party too. They're up 2%. What do you make of this melt up, Barry? How do you explain it? Why has the market proven so resilient here?
Yeah, it's by the way, it's good to see Al Root and put a face with a name. We've talked before. Yeah, there's a lot going on as far as the economy that I think we haven't really seen the full effects of yet. It looks to us like consumption is going to slow in the second half. Some pressure on real wage income. So that's just a product of hours worked, what you make per hour. The other is big tech core businesses where they really make all their profits are very sensitive to a slowdown. And so there could be some negative operating leverage there, sudden and late in second half. Inflation, if you measure it by the core PCE, it looks like it's going to be close to 3%, and we're thinking all the way into first half 26. So that's not what the Fed wants to hear. So you might have to take some rate cuts out of the 26 futures. And then stagflation, which is slowing economy with still sticky inflation. It's not as bad as the 70s. I remember the 70s. But it's enough to put the Fed in a bind and, again, take some cuts out of next year, certainly before Powell leaves. There won't be another Fed chair in a meeting until June 15th.
Barry, when I have bulls on the show, you won't be surprised. They see it a bit differently. And I guess, Barry, broadly, they'll say, listen, Josh, Q2 earnings season, they'll say it's broadly solid. They'll say, Atlanta Fed GDP tracker, where are we here, Barry? 2.5. And they say, yes, the Fed's cutting. They add that up, Barry. They say, what's not to like? What's wrong with that narrative?
Well, if you look at the core of GDP, and you're going to get a lot of distortions with what's going on with trade in inventories, net exports, and government. I'm not so sure that the big beautiful bill is that stimulative. If you look at the $300 billion tariff, and you figure that the portion consumers have to absorb over time, not initially, but over time, is just going to rise. It actually offsets some of the tax cut, the incremental cut, which was not that large versus what we had in the prior 2017 Tax Cut and Jobs Act. I think it's $600 billion over 10 years, $60 billion a year. We'll offset that with tariffs, the part that goes to consumers. So, bull market psychology is something I've seen off and on for many, many years. And we're in that kind of psychology now. It usually breaks suddenly. It rarely breaks slowly. And so we're seeing a number of risks in the back half. And I highlighted some of them. There's several more.
Barry, let's put a number on it. So if the SPX, the S&P 500 is at 64, 66, where do we head from here, Barry?
Well, we're thinking it could, on a significant economic slowdown with the Fed pretty much battling with the White House, and I expect the last 9 months or so of Powell's term are going to be increasingly an outright war. Then what I think will happen is we're looking at 5,500 as a mid-teens correction for the S&P 500. Now, you could certainly see 5,750, a fairly mild 10% type correction. But that's where our numbers are coming at. And we look at it a lot of different ways, some complex ways, such as economic profits versus enterprise value to invested capital, which is actually very close to where it was in late 1999 before that bust. So there are a number of risks that a overly bulled up market, particularly the investors, retail especially, that they're not really cognizant of. I mean, if you think about the demographics of the market and all the people coming into it, if it were that easy to go straight line and make money and quit your day job, then people would have done it a long time ago. It's a very difficult market. It's like going down a mountain road with switchbacks and no guardrails. And so I just would caution people not to be overly bulled up if it's cash that you need within the next year.
So given that backdrop, Barry, that you've spelled out there, how do I want to be position then in the market, Barry? What are you telling clients?
Well, if you think about the Fed, they're the guardians of what's called the neoliberal order, right? They've always believed, and they've written many, many papers on the fact that they believe that you can only have really good economic growth if you have really low inflation. You have a president that wants to run the economy pretty much red hot. He's willing to have the inflation, but only if the nominal growth, the real plus the inflation of the economy, is super strong. So that's a major battle. And then the interlude, while those two fight it out, red hot versus the low inflation is the only way to grow mentality at the Fed, you go with defensives, value-oriented defensives like beat up healthcare, some of the staples like waste companies, utilities. That would be probably a better place to be as they duke it out here in the late third and then early fourth quarter.